Hi there, welcome back to AI Investor Talk. Arthur Laffer, an economist who gained significant prominence during the Reagan administration, is best known for the Laffer Curve, a concept that fundamentally altered discussions on taxation and economic policy. The Laffer Curve illustrates a theoretical relationship between tax rates and government revenue, positing that there is an optimal tax rate at which government revenue is maximized without discouraging economic activity. According to Laffer, if tax rates are too high, they can disincentivize work, saving, and investment, thereby reducing overall economic output and, paradoxically, lowering tax revenues. Laffer is a staunch advocate of supply-side economics, which argues that economic growth is most effectively fostered by investing in capital and lowering barriers on the production of goods and services. This philosophy guided much of the Reagan administration's economic policy, which emphasized tax cuts, deregulation, and a reduction in government spending. One of Laffer's key contributions to economic discourse is his argument that lowering tax rates can potentially increase total tax revenue by boosting economic activity. This idea became a cornerstone of the Reagan administration's tax policy in the 1980s and influenced subsequent Republican tax strategies, including those implemented under President Donald Trump. Arthur Laffer was a vocal supporter of President Trump's economic policies, particularly the 2017 Tax Cuts and Jobs Act, or TCJA. This legislation reduced the corporate tax rate from 35% to 21%, cut individual income tax rates, and increased the standard deduction. From Laffer's perspective, these tax cuts were crucial for stimulating economic growth by encouraging businesses to invest more in the U.S. and by increasing consumers' disposable income. Laffer argued that Trump's tax cuts were consistent with the principles of the Laffer Curve. He believed that by reducing tax rates, the U.S. would see an increase in economic activity, which would ultimately lead to higher tax revenues over the long term. Indeed, in the short term, the U.S. economy did experience strong growth, a booming stock market, and low unemployment following the tax cuts. However, critics of the TCJA, including some economists, have pointed out that it significantly increased the federal deficit, raising concerns about the sustainability of such fiscal policies. Laffer and his supporters countered this by arguing that the growth stimulated by the tax cuts would eventually offset the initial revenue losses through expanded economic activity and higher tax receipts in the future. The sharp reversal in policy needed for economic survival. Laffer has been increasingly vocal about the need for a dramatic shift in U.S. economic policy to prevent what he sees as a looming economic crisis. His concerns center around several key issues. First, rising government debt. Laffer is deeply concerned about the rapidly increasing federal debt, which has ballooned in recent years due to a combination of tax cuts, increased government spending, and most recently, massive fiscal stimulus in response to the COVID-19 pandemic. He argues that this debt burden could lead to higher interest rates, crowding out private investment, and ultimately slowing economic growth. Second, inflationary pressures. Laffer warns that the unprecedented levels of monetary stimulus from the Federal Reserve, combined with expansive fiscal policies, could lead to runaway inflation. He believes that inflation erodes the value of money, distorts economic decision-making, and disproportionately harms lower-income individuals who are less able to protect their wealth from rising prices. Third, excessive regulation. Laffer has consistently argued that overregulation stifles economic growth by imposing unnecessary costs on businesses and reducing their ability to innovate and expand. He has praised Trump's efforts to roll back regulations, but he remains concerned about the potential for future administrations to reimpose or even expand regulatory burdens. Fourth, fiscal responsibility. Laffer advocates for a return to fiscal discipline, emphasizing the need for the government to balance its budget over the economic cycle. He argues that continued deficit spending is unsustainable and will eventually lead to a fiscal crisis, potentially forcing the government to raise taxes or cut spending in ways that could be harmful to the economy. Lastly, monetary policy. Laffer has also called for a reevaluation of current monetary policy, particularly in light of the Federal Reserve's aggressive interventions in financial markets. He believes that ultra-low interest rates and quantitative easing have distorted markets, fueled asset bubbles, and could set the stage for a financial crisis if not carefully managed. Laffer's vision for ideal tax policies. Laffer's ideal tax system would be characterized by low, broad-based taxes that minimize economic distortions and maximize efficiency. He argues for the following principles. First, low marginal tax rates. Laffer believes that keeping marginal tax rates low is crucial for incentivizing work, saving, and investment. He advocates for a flat tax or a consumption-based tax system that would simplify the tax code and reduce the disincentives associated with high marginal tax rates. Second, a broad tax base. Laffer supports broadening the tax base by eliminating loopholes, deductions, and exemptions that complicate the tax system and create opportunities for tax avoidance. A broader base allows for lower rates without reducing revenue. And finally, simplification. Laffer argues that the tax code should be simplified to reduce compliance costs and make the system more transparent. He believes that a simpler tax system would reduce the resources individuals and businesses spend on tax planning and compliance, thereby freeing up those resources for more productive uses. Challenges and criticisms. Laffer's ideas, while influential, have faced significant criticism from various quarters. Critics argue that the Laffer curve oversimplifies the relationship between tax rates and revenue, and that it is difficult to determine the exact point at which tax rates become counterproductive. Additionally, some economists contend that the benefits of tax cuts are often overstated and that they can lead to increased income inequality and underfunding of essential public services. Moreover, the impact of the Trump tax cuts on long-term economic growth remains a subject of debate. While the U.S. economy did experience growth in the short term, the increased deficit and debt levels have raised concerns about the sustainability of such policies in the long run. Conclusion. Arthur Laffer remains a key figure in economic discussions, particularly around tax policy and fiscal discipline. His advocacy for low taxes, limited government, and a sharp reversal of current economic policies reflects his deep concern about the direction of the U.S. economy. Laffer's views continue to influence conservative economic thought, and his warnings about debt, inflation, and regulation highlight the ongoing debate over the best path forward for the U.S. economy in a rapidly changing world. Thank you for watching. Please like and subscribe.